Well, good morning. I'm Dave Weisberger, CEO of CoinRoutes, on location in my hotel room from the trading show in Chicago, where a show that used to be pretty much exclusively dedicated to high-frequency trading and vendors has moved more and more toward algorithmic discussions of artificial intelligence and building more sophisticated ways of accessing markets, and quite frankly, is dominated by maybe half of it or even more is dominated by crypto and digital assets as the next frontier in investing. We had an interesting week, met many hedge funds, talked about market structure, talked about why our software is particularly useful, but that's not what this week is about. The fact of the matter is, while we were playing at the conference and having fun, many things happened this week. But let's start with the markets. Yesterday, a lot of people got excited because they saw a day where Bitcoin and Ethereum and the rest of the digital asset world essentially went up when more traditional markets went down. But if you zoom out, while there's a small delink over the course of the last 7 days, it's not incredibly significant. The fact is, Bitcoin and Ether are both in the middle of their long trading range, Bitcoin in particular. In fact, bumping up against 20,000, which is pretty much the dead middle of the range that we've been talking about for weeks upon weeks upon weeks, between the 18s and the 22 level. The fact is, we're right in the middle. Nothing much has changed. Speculators are still dominating the market. It's just that speculators are getting more and more cautious as Bitcoin shorting is a very crowded trade. People in this run-up yesterday basically got liquidated. When you have trades where almost the entire community says, well, we all know Bitcoin's going to drop, therefore maybe it won't. I've been saying that for a while. I think that this continues. Not saying it can't drop, not saying that markets globally can't have a problem. But the other thing to keep in mind is what's going on in FX, because that was far more interesting over the week. The British pound over the last week saw a pretty much record one-day fall, followed by a slow recovery of 50% retracement of that drop. And the British pound, otherwise known as British pound to dollars, known as cable for obvious reasons, is the cable underneath the Atlantic, is one of the most heavily traded FX pairs. That size move over the course of a week, while not completely historic, is certainly extremely interesting and very different. And it also points out something. If you look at the currencies, whether it's the yen, which is 18%, or the euro and the pound that are between, depending on how you measure it, between 10, 11% or 15% down against the dollar, it means that Bitcoin in those currencies looks very, very different. In fact, while it's not obvious that it's causative, there has been records in terms of Bitcoin pound trading. And while it's not at all clear that Bitcoin is the safe haven for people in the UK, in my opinion, for long-term investors, it probably should be, but that's neither here nor there. It's not clear that that is the case. The fact is, watching Bitcoin from a perspective outside the United States is very important. As my co-founder said in one of the many videos we've been posting over the course of this conference, you need to look at Bitcoin from the perspective other than the dollar at many times. 30% of the world have currencies they cannot rely upon, and Bitcoin is a safe haven for those people, more and more and more so. As currency instability increases, that should catch a bid for the Bitcoin use case. Now, the rest of crypto is a different story. So this week, there's been some very interesting news. The first piece of news was an investigative piece by Eleanor Terrett on Fox, where she talked about the calendar being released from Bill Hinman at the SEC. Now, I don't know Bill. I do know that his speech giving Ethereum a free pass as it's not a security was a watershed event for many cryptos. And people treated that as a very, very big deal. We also know, and we talked about last week, that of course Chair Gensler wants to take that back because Ethereum is now proof of stake. Without regard to the absolute insanity of the power-grabbing extent that Gary Gensler wants to take in, it's still extremely important to understand how the SEC operates. That calendar proved that Mr. Hinman met many, many times with executives that are on the Ethereum side, and not any times with people in this particular case, XRP or Ripple, or in fact many other tokens. That could be a very big deal. The other big deal from a policy point of view probably wasn't noticed by much. It probably won't go very far because, as far as I can tell, it's not bipartisan yet. But Bill Hagerty proposed a bill which should be incredibly obvious. The bill basically says give crypto exchanges a 2-year grace period from the time that any tokens that they are trading are, quote, declared securities. Now, keep in mind a couple of things here. First, the SEC could, during that 2 years, basically stonewall and screw over those exchanges. But without that, effectively what it means is that the SEC calling something a security is a death sentence for Coinbase or any other market that is in the United States that is trading cryptocurrencies. Now, why do I call it a death sentence? Not because they're doing anything wrong, quite the opposite, but simply because SEC rules do not work for crypto. Mr. Gensler continues to say that they do. I continue to say I will debate him publicly in any fashion on why. But the reasons are obvious. The most obvious reason is all of these exchanges trade almost all of their tokens against dollars, against stablecoins, and against Bitcoin. So if you have a token that is a security and it trades against Bitcoin, that is a commodity. That would mean that individual transaction has to be regulated by the CFTC because Bitcoin's a commodity, and by the SEC if they declare it a security. Those rules overlap, contradict, and cannot possibly be navigated. They have to be normalized. The SEC needs to change rules that are not built for digital assets. And if you don't do that during a 2-year grace period, we will never get to regulatory clarity. Now, to be fair, Hester Peirce, Commissioner Peirce, said this years ago. And the chair, both Clayton and now Gensler, have ignored her. Hard to understand why, because it's the only thing that makes sense. But if the only thing you care about is either keeping the industry down and not having it on your record, that's Clayton, or trying to take over the industry and own it so that he could suppress it for his own political gain, that's Gensler, then you would understand that you don't care about the investors either in the tokens or in the companies that are working in that ecosystem. So that's that. Last week, I didn't talk about a case which is really important as well, which was the hack of Wintermute. This case has significant meanings for DeFi. And the reason I didn't talk about it is I wanted to find out if it was a white hat, ethical hack or not. That is clearly not the case because despite their pleas, the money hasn't been returned. Why is it so important? Well, it's important because one little discussed aspect of DeFi is that the market structure is pretty primitive. The market structure effectively biases towards market makers dramatically and against liquidity takers. Liquidity takers pay 30 basis point fees to Uniswap, and they pay significant spreads to the automated market makers. And the reason they have to do so, one reason they have to do so is because market makers, A, take a lot of risk, which we'll discuss in a heartbeat, and B, market makers don't have what they have in other markets. In every other market, market makers can place a price and only make the decision to respond to incoming customer order flow at that exact instant based upon what the exact price is. In DeFi, prices are much harder to adjust because it's based on liquidity pools, which are not nearly the ability to do price discovery as a order book would in its infinitesimal moves. The fact is, it also doesn't have the ability to adjust for price discovery as an auction market moves, even though that will end up being at a point in time that liquidity gets adjusted in a way where the market makers don't have to take risk. So that excess risk that has to be borne by market makers means it is guaranteed to be more expensive. But this hack shows another aspect of it. In DeFi, you need to hold your assets in the pool, which is accessible to the known universe, i.e., a hot wallet, as it were. It's actually not a hot wallet, it's a smart contract, but it doesn't matter for the course of this discussion. It means you have to have all your assets there. And obviously, based on this exploit, they are vulnerable. So that extra risk needs to be taken. Now, I am a huge proponent of DeFi and where it can go. I also believe its market structure needs to evolve. I think DeFi will disintermediate many financing businesses, from securities lendings to repo to interest rate swaps, and has a very, very bright future. I also believe that Aave and all the other DeFi protocols held up much better when it came to token lending than human-based companies. So, and that's obvious. So the reality of the situation is, I'm not against DeFi, but I do think that DeFi practitioners need to wise up and understand that a more balanced market structure is going to be necessary for its future growth. Well, that's enough for today. I've gone on a little bit longer than usual. Thank you. Have a great week and stay safe out there.